So we are going to cover this topic for today, the group accounting stroke consolidation. So for today's session, there's no question which will be done. What I will be talking about is not about what you need to know basically in the topic, the major adjustments which are made and how they can test a question of consolidation in the advanced financial reporting. So why do we do group accounting? That is the first thing I will have to mention. So what's group accounting? Who can give it a try? What is group accounting? Who can try?
Combination of parent and a subsidiary.
So the combination of the parent and subsidiary.
Yeah.
Anybody else? You can expound more about the combination so that we do what? Once we combine, what are we trying to do?
I think the concept of group accounting is combining together the financial statement of the subsidiary company and the parent company as a single entity.
And so we do group accounting for that purpose. So the main objective of the business combination is to enable the acquirer company to report on the operations of the acquiree, companies as if they belong under one economic entity. So remember that in group accounting, you would be having like now, A, it had acquired these companies, B, C, and D. You might find that these are the companies acquired, B, C, and D. So you might find that this one is acquired up to 80%, this is 50%, and this let's say 30%. So remember that on this scenario, we always look at the percentages of acquisition. So we have said 50, we have said 80. So let's say up to 49 from 20%, from 20%, and let's say 51% to 100%. So remember that this is the acquirer company. These are the acquirees. These are the acquirees. So these are the investee companies. These are the investee companies acquired by the parent. So these investee companies, if the percentage of acquisition lies at 51% to 100, this one will be a subsidiary. So the acquired company, which is acquired and the percentage of acquisition lies at 51 to 100%, that is a subsidiary. So this is a joint venture. And here we have what we call associate. So that is 20 to 49. So like now B is a subsidiary, C is a joint venture, D is a associate. So this is acquired between, B is acquired between, it lies at this bracket. If it's C exactly at 50%, then D rise between 20 to 49%. So on this scenario, on this case, as I admit, some of your colleagues here, remember that in an exam scenario, you would be given statements of A, which is the acquirer, B, C, and D. So in this scenario, A must report on the operations of the acquiring companies. A must report on the operations of the acquiring companies, that is B, C, and D, as if they belong under one economic entity. So by the end of the year, A must report on the operations of B, C, and D, so that they look as if they were one. I think you have understood why we do that, why we do consolidation. It's not about the acquirer company, that's to report on the operations of the acquiring companies, so that they will look as if they were just one. All right, so these key terminologies, which you will be coming across, of which some of them I've mentioned here, some of them are mentioned here. So key terms to be mentioned on this scenario, we have right now the parent company. We'll be talking about the parent company. So the parent company is the one which acquires the others. So it's all about the acquirer. So it is the parent. Then we have the investee companies. Like now we have the subsidiary, which I've talked about. We have a subsidiary. Other than subsidiary, we have a joint venture. We have joint venture. And we have what we call, other than joint venture, we have an associate. We have associate. So for the parent, I've talked about it, subsidiaries, joint ventures, and associates. But now the one I want to insist more on is all about the subsidiary. Well, this one was there in our sitting, and it was challenging many students how to identify that this is a subsidiary. So I think what you know that in identifying that this is a subsidiary, what do you look at on your case so far for the consolidations? For the consolidations you have done, how do you know that this is a subsidiary? Just a direct question I've asked. How do you know that this company is a subsidiary of the parent company?
It's acquired more than 50%.
Yeah, so other than that one, other than that, yes, that is the first one. That is the measure, by the way. But now there's this question of receipting. There's this question of receipting. There's something I want to open here from my phone. That is where you can see I'm on my phone. It's something I want to share with you guys. Where is that? So I was mentioning about the aspect of a subsidiary to be considered, that circumstance under which a subsidiary is considered to be a subsidiary. So the first thing we look at is all about the percentage of acquisition, which must be more than a half. That is 51% and above. So, but other than the percentage, there are two other requirements. So the representation of the parent in the board of the subsidiary. So if the board is inclusive of some of the members from the parent, and number three is participation in the financial and operating policies of the subsidiary company. Participation in financial and operating policies. The participation in the financial and operating policies. So those are the three circumstances. Representation in the board, participation in financial and operating policies of the subsidiary. So I think now you know, other than the percentage which you are talking about. Now, if we look at our sitting question, I think this one, question 3, they were mentioning that H Limited, a public limited entity, operates in the information technology sector. It has made several investments in other companies within the industry, so which has earned market leadership in the sector. The foreign draft financial statement for the end of 31st October 2022 rates to H Limited and its investment companies. So we have H, it acquired S and L. Now I want to look at the additional information. How did they mention about the acquisitions? So let's go to note 2. They said M is the main competitor of H. Not even note 2. Note 1, they said H acquired 80% of the shareholding of S. So H had acquired what? S. H had acquired 80% of S. S Limited. So 80%. Then in note 2, in the additional information number 2, what they said is that what they said is this in note 2. M is the main competitor. There is a company called M, which is a competitor. So M, competitor. M is a competitor of H. On 1st May 2022, M and H each acquired 50% of the 200 million ordinary shares of shillings 10 each in L. So they both acquired what? L. They both acquired L. So 50%. Let's say this company H, they acquired L 50%, and there's this competitor who acquired another 50% in L. He acquired 50% in L. But according to our question, currently we know that the parent is who? The parent is H. So it had acquired S and L. It's only that now they are trying to be more specific that the other 50% in L is controlled by a competitor, which is M, which is M. Now, what we need to know, what I need to conclude is, how will be L be treated? Joint venture or subsidiary? How will L be treated? As which type of company?
Joint venture.
Joint venture.
Yes.
So the joint venture. But now, if we read our additional information, so if you can read well this additional information, so the joint venture you talked about will be disqualified, because there's somewhere here they said that upon the acquisition, H Limited had a contractual right to appoint 60% of the board of L and make sure that everybody is mutant. So remember that H and M, they had acquired 50-50 in L. But now they are saying that H had a contractual right to do what? He has a contractual right to appoint 60% of the board of L. So he has more power to appoint more members. That is more board members in L than M. He has the 60% contractual right, with the remaining 40 appointed by M. With the remaining 40 appointed by M. So M Limited and H Limited each appointed one member to L. So there's that M and H. Each appointed one member to L, senior management team. So it's the senior manager appointed by H who makes key decisions regarding the development of L Limited's new technologies, its principal revenue stream, the market it will operate in, and how it's financed. So the fair values of L Limited is net assets approximated. So for now, until up to what I've read, is still L a joint venture to H, according to the circumstances which I mentioned. So remember that I said for a company to be deemed a subsidiary company, there must be representation of the parent company in the board, or whether there was one member represented in the board. And remember that H was the one which was appointing 60% of the board members, and the 40 being appointed by who? M. So meaning that they don't have equal, they don't have equal rights. H and M, they don't have equal rights in L. Who has more weight? Who has more rights? Must you mute your mic? You are making a lot of noise. So the company which has more rights in L, it's H, because it was appointing 60% of the board members. its senior manager is the one who is doing what? Making key decisions regarding the development of L Limited's new technologies, principal revenue stream, the market it will operate in, and how it's financed. So meaning that H has more rights in L, unlike M. So meaning that H, when it will be consolidating, when H will be consolidating this company L will be considered as a subsidiary, not a joint venture. So meaning that on the consolidation, H plus S plus L will be added together. Well, you have to consider that S and L are there for the entire year. Were they present for the entire year? Remember that when doing the income statement, if S is existing for some months, you have to prorate. The same way with L, you have to prorate. So I think that is the first thing I've understood about subsidiaries. So
Malema, I have a question.
yes.
So are we going to use the 50% or 60%?
The 50%.
The 50%, okay.
Yes. So that is for the subsidiaries. So those are some of the key terminologies. Another key terminology is all about, another key terminology you need to know is all about non-controlling interest. So who are non-controlling interest? The minority shareholders, the NCI, the non-controlling interest. So for the non-controlling interest, this is all about the companies which are. So for the non-controlling interest, remember that a non-controlling interest is the interest which is not acquired in the subsidiary. The minority shareholders, the minority shareholders in the subsidiary. So right now, if the subsidiary is acquired up to 80%, meaning that 20% is not controlled by the parent. So this one goes to the minority shareholders. Minority shareholders. This one goes to the minority shareholders. That one goes to the minority shareholders. Then now in advanced financial reporting, again, another terminology I have to talk about is all about sub-subsidiary. Sub-subsidiary. The sub-subsidiary. What are the sub-subsidiary? So these are the investee companies which are controlled by the subsidiary. Let's say A acquires B, then B acquires C. So on this scenario, if this one is acquired up to 80%, then this is 60. Remember that for B, B is a subsidiary to A. But now C is a sub-subsidiary. It's a sub-subsidiary. C is a sub-subsidiary. C is a sub-subsidiary to A, but B is a subsidiary to A. B is a subsidiary to A. So, and also here you need to understand when doing consolidation that B will be consolidated at 80%. What about C? C will be consolidated at what percentage?
48%.
48%. 48%.
48%, because you have to multiply 80% times what? 60. So meaning that this 48% again is becoming less than 51, less than 50. Will this one change now to be an associate? No. Will this one change to be an associate? This one will not be an associate. So this one will remain to be. This one will remain to be a subsidiary.
Sub-subsidiary.
A sub-subsidiary, yes, a sub-subsidiary, but at 48%. So what dictates is the initial percentage, which was more than 50. This one was 60. So even if once we multiply 60 by 80, and this one comes less than 50. So this percentage will not imply that now we treat C as an associate. No. So this one will be treated as what? As a sub-subsidiary. So that is fine. I think I've done that. Then we have what we call a legal framework in group accounting, legal framework, and the institutional framework. So remember that we always say that if the parent company has subsidiaries, we have always to do consolidation. That is according to the law. The parent must do the consolidation of those investee companies, which is a subsidiary, and present during the AGM. It presents to who? Shareholders during the AGM. So, but now there are circumstances whereby you will find that the parent can be exempted. The parent can be exempted. The parent can be exempted in doing what? In consolidating for subsidiaries. Even if yes, the parent has a right to consolidate for the subsidiaries and present the consolidated statements during the AGM, but there are some scenarios where the parent is not given that opportunity to do that. These are the exemptions. If the subsidiary was acquired and it's lasting for less than 12 months, where the shares of the parent are not trading, where the parent doesn't file annual returns, and where the parent itself is partly or fully owned by another company. Right now, on the scenario of this sub-subsidiary, where you find that B is behaving like a parent of C, but remember the B is already controlled by A. B is already controlled by A. So in group accounting is all about understanding those small things. So in institutional framework is according to International Accounting Standards 27, whereby again, if the parent company has a subsidiary, he has to do what? He has to prepare consolidated financial statements and present to the AGM, that is to the shareholders during the AGM. So the exemptions remains the same as that of a legal framework. The exemptions remains the same as those of a legal framework. So we go to Goodwill. Goodwill. So we need to mention about Goodwill. So mentioning about Goodwill, and that is another major area you have to look at. Goodwill. So remember that under Goodwill, for the Goodwill, so Goodwill is all about, anyway, before I mention about it, it's under IFRS 3. We'll be talking we are talking about IFRS 3, International Financial Reporting Standards 3. That is the area we'll be covering here. So when we talk about IFRS 3, Goodwill, so Goodwill is a future economic benefit expected from the usage of the asset. So any asset which is put into use, you have to check its Goodwill. Let's say mostly assets which are for commercial purposes. Today, even if you acquire a building, a property somewhere, so you have to check its Goodwill, its reputation. Will you get customers? So if it's a business you are starting, or you are acquiring a certain business, you are acquiring shares, how is the goodwill of that company? So once there's a good reputation of the company, obviously there will be an economic return, the future economic benefit expected from an asset. And you cannot be able to separate goodwill from the usage of the asset itself. So it's just goodwill and the asset itself is just one thing. So it's all about future economic benefit expected from an asset. So when we talk about goodwill, remember that for you to do goodwill, you can use either full method or partial method. You can either go for the full method or a partial method. So on which scenario can you use the full method? So we have the methods to be used. So full method. So let's start from full, the first one. For you to use full method, and this one is mostly applicable. Full method is mostly applicable under subsidiaries. When you are dealing with subsidiaries, mostly under subsidiaries, you can't use full method in associates or joint ventures, no. So it's applicable in subsidiaries, but on the cases where you are given the favor of NCI. Favor of NCI is provided. So the NCI, that is non-controlling interest, is said to be stated at its fair value. If you will not be given the favor of the NCI, you can be given information which will aid you in the determination of this. So that is, if the number of ordinary shares in the subsidiary, if the number of ordinary shares, now if the number of ordinary shares in the subsidiary are stated at fair value, as acquisition date. So if you are given the number of ordinary shares which are fair valued, so they are stated at fair value as at the acquisition date. So meaning that for you to determine now, on this scenario, for you to determine the favor of the NCI, you will take the percentage of NCI times the number of ordinary shares of that subsidiary. Number of ordinary shares times what? Times that fair value. You know that the fair value is the market value, fair value. So once you do this, you will be able to arrive at the favor of the NCI. So the goodwill arising from the use of full method, is attributable to the parent company and the non-controlling interest, the minority shareholders, that is. So the goodwill arising from the full method is that goodwill of parent plus what? Plus the NCIs. Parent plus NCI. For the partial method, so partial method can be applicable again in subsidiaries and joint ventures and associates. So for the partial method, it's applicable in all the investee company. But on which scenario can I use the full method, the partial method? Let's say in subsidiaries, when the NCI is not stated at its fair value. When the NCI is not measured with its fair value. That is, I think there's nothing I have to write on that. You are understanding what I'm saying. That partial method is only applicable when, let's say in subsidiary, it will be applicable if the NCI is not measured at its fair value. So meaning that the goodwill arising from the use of partial method, is attributable to the parent company only. It's attributable to the parent company only. So remember that we always say that goodwill is equal to what? A purchase consideration minus share of net assets acquired. Purchase consideration minus share of net assets acquired. So what I need to mention about is, or about the purchase consideration. Remember, the purchase consideration can be given direct, or it cannot be given direct. They can mention about the purchase consideration through share exchange. They can say that when, let's say, A was acquiring B, they did a share exchange. That is, for every 2 shares, which A was having, they were getting 3 in S. In B, that is 3 in B. 3 in B. So 2 shares of A for 3 shares in B. So once now you know that what do you have, you will be able to determine your purchase consideration. So in terms of share exchange, remember that you have to do those workings for you to determine the purchase consideration. If it's through share exchange, there's a question we did from FR, or there's a question in FR of this kind. September 2015, question 1. So if it's through share exchange, remember that 2 shares of A for 3 shares of B, what I will come here and check is all about the ordinary share capital in B. Let's say if your ordinary share capital in B is at 2,000 and the par value was 10. So meaning that for B to raise a capital of 2,000, it means that they issued how many shares? It's 200 shares. But let's say if A acquired B 60%, I have to multiply 60% of this. Then I have to cross multiply what I'm getting. So it's about 60% times 200 times 2 over 3. So I will be able to get the number of shares which A acquired in B. Then from there, I have to go to my ordinary share capital. And I will mention about ordinary share capital. So what I'm getting from here, that is what I will multiply with the par value. So to get my ordinary share capital, I have to multiply with the par value what I'm getting from here. And you have to check if there's share premium. If they will say that, for example, currently in the market, the shares of A are a trading rate, say at 15, it means that the shares of A, which are acquired from B, if they were to be sold currently, they will sell at an excess of 5 shillings, because I have said that the par value is 10. So meaning that they will be an excess of 5, and that is what you will have. So what you got here, you will multiply with the excess, which is a premium, the excess of 5. So I will be able to check an illustration in the advanced level concerning share exchange. But the one which I've seen, which is common other than share exchange, in advanced level, when determining the purchase consideration, is what they call, when determining the purchase consideration, is what they call deferred consideration. So there's something they call deferred consideration. So the purchase consideration might not be direct, but they can say like now, A acquired B today. Let's say 1st January 2023, A acquired B. On the process of acquisition of B, he paid what? Cash immediately of 10 million. And let's say he issued shares of 1 million at a price of 20 each. So you have 20 million. Let's say it's all about 1 million shares of 20 each. Then you know that the acquisition was January 2023. Then they said that after 3 years, so after 3 years will be 2020 what? It's 2025. At the end of the year 2025, they will pay another additional. They will pay additional cash of, let's say, 80 million. So would I add this here direct? Because this one, remember, is paid in the future. The addition is paid after 3 years, will be paid after 3 years. So to get my purchase consideration, what would I do with the 80? Well, this one will be paid in the future. Financial management people.
I think it should be
Discount.
It should be discounted. So it should be discounted. So meaning that when we discount, which formula would I use? Formula for discounting?
I think the question should be given the cost of capital, right?
The cost of capital will be provided.
Okay.
Which is, but now I need the form. Remember that I've already given you that this amount will be paid once in the future. So you will be given the cost of capital. How will you use your cost of capital? Using which formula?
Future value times into bracket 1 plus R into brackets.
So the future
L.
value into brackets
1 plus R
1 plus R
to
raised
the
to
power of N.
and the power of N. Correct. That is correct. So that is what you do. So you have to discount using this formula. So you say 80 million times. So 1 plus R. So you would be given the cost of capital. Let's say you are given 10%, you say 0.1. So N is time. So I said after 3 years. So you raise to 3. That is the case. So the future values must be discounted to the present. Then now the answer you get here, you will add to your, remember this one was started, this one was paid on the date of acquisition. So you have to add with the deferred. So this is what they call deferred consideration. So that is what is called deferred consideration. So you have to discount it to the present period. It has to be discounted to the present period. And this one, they tested it sometimes back. So they can test that. So once you see something of that kind, you know that you have to do a discounting. You have to do a discounting. So that is okay. So mentioning that means that next I go to adjustments, which are supposed to be done. I think there's nothing I have to. Yes, I go to key adjustments in group accounts. Is there any question? So the key adjustments in group accounting so that we know what we are supposed to do. So the first adjustment, so the key adjustment, I will be doing one by one. So key adjustments. So the first key adjustment in group accounting is what we call unrealized profit on stock. So I always use the word UPS, unrealized profit on stock. So this one arises due to the sale of goods. This one arises due to the sale of goods. So you will find that, and mostly, even before I explain about it, I will be using examples of parent and subsidiary, A and B. A is the parent and subsidiary B, because the adjustments which we do, key adjustments, which we do in group accounting, most of them are between parent and subsidiaries, because parent and subsidiaries are the ones which are considered to be group members. So adjustments which are done is for the group members. So the transactions which occur between parent and associates or joint ventures are never adjusted in a group accounting. It's only that in the associates or joint ventures, the parent must maybe take some income, or he must take his share from those associates or joint ventures, not adjustments. So if there is some transactions which took place between the parent and associates and joint ventures, those are irrelevant. So most of the adjustments which we do, or the adjustments we do, is the transactions which took place between the parent and subsidiary, because those are the group members. Those are group members. So on this scenario, let's say now there's a goods which are sold from A to B or B to A. So when A sells to B, A is the parent, sells to B, subsidiary. So that is a downstream sale. If it's B to A, that is an upstream sale. So what we look at is the recipient of these goods. Let's say if it was A to B. So remember that when A was selling these goods, he sold at a profit. He sold at a profit. So B receiving them, remember B had already paid for the goods. B receiving them, we have to check if B did what? Did a resale of all the goods. But if by the end of the year, B never resold all the goods he received from A, it means that there's a profit which B never did what? Realized. There is some profit which B never realized, because he never resold all the goods he received from A. And that one implies that the profit of A is overstated by what B never realized, based on the goods B never resold. So in group accounting, we have to avoid profit overstatements. And that is when transactions occur between the parent and subsidiary. Then one entity is making more profit than the other. That one must be avoided. We have to avoid profit overstatement. That is why we always determine that profit which is unrealized, and it must be eliminated accordingly. So like now here, if it's B will never resold all the goods received from A, it means that in the books of A, the profit is overstated. So we have to determine that unrealized profit so that we eliminate in A. So the profit elimination depends with the sales stream. So it can be an upstream sale or downstream sale. So if it's a downstream sale, remember that the profit B never realized will be eliminated in the parent. So this one, it depends on the sales stream from the parent to the subsidiary. Parent to the subsidiary, or we can have what we call subsidiary to who? Subsidiary to parent. So on this scenario, we eliminate the profit here. On this scenario, we eliminate the profit in the subsidiary. So unrealized profit on stock is determined by taking unsold goods times profit margin times the profit margin. So profit margin is the profit on the selling price. So meaning that if you are given a markup, if you are given profit markup, you have to change it to margin. So when they say that profit on cost, that one means that is markup. Profit on cost. Let's say 20% profit on cost. That is a markup. Or they can just say a profit markup direct. So you have to change it to margin. So if you are given a markup of A over B, it means that margin will be A over B plus A. So meaning that if this is a half, if markup is a half, margin will be a third. If it's 2 over 5, this one will be 2 over 7. You see that? So elimination of the profit, let's say downstream sale. So due to downstream sale, the profit will be eliminated in the parent by debiting what and crediting what. So which account will be debited and which one will be credited? So you debit retained earnings account. And you credit the inventory account. You credit inventory account. So this is downstream sale. So what about upstream sale? Now in the upstream sale, remember that it's from the subsidiary. In the subsidiary, you will find that the subsidiary is not controlled 100%. There's an aspect of NCI in the subsidiary, minority shareholders. So they must be considered. So you debit, credit. So you debit your retained earnings because now you have to reduce the retained earnings. Retained earnings account. You have to credit, you have to debit NCI account, and we credit inventory. So meaning that on this scenario right now, if it was an 80% subsidiary which was acquired, then we have a UPS of 200, which is overstated in B. So how would I share it in this scenario? How would I debit, then credit? So on this scenario, I would say 80% of the 200 goes to the retained earnings, 20% for the NCI, 20% of 200. Then now the total amount of 200 is credited in the inventory. That is what you need to know for the UPS. There's nothing else. Is there any question?
Also, teacher, for the markup and the margin, which one to be A plus B?
When you are changing markup to margin,
So
if it's
you can repeat that.
if you are given markup A over B, so margin will be A over B plus A, meaning that you add the numerator to the denominator. Numerator, you know a numerator from mathematics.
Yes.
Denominator. You know those things. I'm not teaching maths. So here, if this one is a half, it means that this one will be a third, because you have to add the numerator to the denominator. But one is not a constant. That is why I used another example. If this one is 2 over 5, this one will be 2 over 5 plus the 2. So it will be 2 over 7. So some of the students, they will say that plus 1. 1 is not a constant. 1 is not a constant. Here, adjustment number 2.
Mwalimu, are there instances where you're given the unrealized profit in margin? As in
You are given?
direct, as in inakuwa margin directly.
You would be given on cases, on some cases, you would be given that this is margin.
So how will you differentiate?
See, it's unsold goods times margin. See, if you are given margin, it will be easier. You take the unsold goods times the margin.
Okay.
So what I'm saying is that what if you are given markup, because now they can complicate things. So you change it to margin. But now if you are given margins, you multiply with the unsold goods.
Okay.
Then number 2 is what about unrealized profit on the fixed asset. I always use the word UPFA, abbreviation, UPFA. So this is now fixed asset, fixed, which is sold, which is transferred in other profit. Fixed asset transferred other profit. So A and B. A transferred a fixed asset to B. A making a profit. But now they will never tell you that B resold the asset. When there's an asset which is transferred, obviously they would use words like plant or an item of property, plant and equipment was transferred from the parent to the subsidiary and the profit of 20%, then they will just remain silent. So what you need to know is that you conclude that the subsidiary will never resell that asset. That is what you need to know, that the subsidiary will never do what? Resell that asset. So meaning that the profit which the parent realized will never be realized by the subsidiary. The profit which the parent made will never be realized by the subsidiary. And that one means that on this scenario, if it was transferred at 200 million, then it transferred at a profit of 20%. So this profit which A made, the profit which A made, which is 20% of the 200, will never be realized by B, because B will never do what? Resell the asset. So meaning that the profit which A realized, which is never realized by B, that one means that the profit of A is overstated on this case. The profit of A is overstated by what B never realized, because he never resold that asset. That is why we need to check the unrealized profit on fixed asset here, so that we do what? We eliminate in A. We eliminate in A. So how do you determine the unrealized profit on fixed asset? It's all about the transfer value times profit margin. Transfer value times the profit margin. Transfer value of the asset, you multiply with the profit margin. That one means that if you are given a markup, you do what? You change it to a margin. If you are given a markup, you change to margin. All right. So then remember that this profit must be eliminated on the books of the parent, let's say on this scenario. And mostly for the fixed asset, it's obvious from the parent to the subsidiary. So this profit, which is realized in A, will never be realized by B. That one shows that A's profit is overstated, and it should be eliminated by doing what? Debiting the retained earnings account. Remember that we reduce the retained earnings account when we debit it. Then since it's an asset which was sold, we credit the property, plant, and equipment account on the process of eliminating that profit, which is overstated. So after this, what you need to check is you check for depreciation overcharge. Next, immediately after computing for the UPFA, you have to check for depreciation overcharge. How would this arise? Remember that once the asset was sold from A to B at 200, A making a profit of 20, they will go ahead to say that the group charged depreciation at, let's say, 20%, or the remaining life of the asset was 5 years. So once you see end of the statement, maybe percentage given, that is for the depreciation. They will say that the group charged depreciation at 20%, or you are given the remaining useful life. Automatically, you have to think that you are supposed to do depreciation. But why these are depreciation overcharge? Remember that they will say that the group charged depreciation. The group is both the parent and subsidiary. So on the scenario whereby there is a sale of fixed asset from the one entity to the other, after computing your UPFA, you have to check for depreciation overcharge. If the asset is depreciable, the only asset which is not depreciable is land. So you have to check for depreciation overcharge, of which you will be given the percentage of depreciation. So meaning that this depreciation overcharge will be based on the UPFA times the depreciation rate, or the UPFA, you divide what? The remaining useful life. The remaining useful life. So depreciation overcharge, the depreciation overcharge. So what does it mean? Or what does it imply? Depreciation overcharge implies that our value of the asset was understated. If we do a depreciation overcharge, we have understated the value of the asset, meaning that both A and B subjected the same asset to a depreciation. And that one means that we understated the value of the asset. So we need to correct that. We need to do a correction. How will I do this correction? For the depreciation overcharge. So for me to avoid the understatement of the asset, I will debit my PP account and credit the retained earnings account. Retained earnings account. You have done that correction. That is how the correction is done. So those are the two things you look at when you are talking about the sale of fixed asset. So you have to check for the unrealized profit on fixed asset and depreciation overcharge. Terminology number 3. Revaluation gain. Group accounting is very interesting and very nice.
If it is upstream sales,
An asset cannot be transferred from the subsidiary to the parent. So the main
Right.
purpose, the main purpose is that the parent is the one. Remember that this one is not supposed to be even a sale. It's supposed to be a transfer. It's only that the parent is transferring the asset at a profit instead of just transferring the asset from the parent so that it can be used in the subsidiary. So it's like you are taking a motor vehicle, you are giving to the subsidiary to use it, but now you are giving them, you are giving out these asset at a profit, of which that one was not supposed to be the case. You were supposed just to make a transfer. Can a subsidiary transfer an asset to the parent for business purpose? It's very rare, even practically. Because everything is done at the parent. So the next thing we have to look at is the revaluation gain. The revaluation gain. So we always say that the revaluation is the difference between what? Difference between the fair value. Difference between the fair value or market value. Yes, and the carrying amount, as said by one of our students. And the carrying amount. So the carrying amount is again called the net book value. Net book value. So the difference between the fair value, stock market value, and the carrying amount. So the difference between the fair value, stock market value, and the carrying amount. Yeah. So after now, we have already said the difference between the fair value, stock market value, and the carrying amount. So the difference between these, the difference between this and these, the difference between that and that. So that is what we call revaluation gain. So other than just remember that this one can be tested in 3 ways. The revaluation gain, how will you determine that there's a revaluation gain in an exam setting? So you will be given the fair value and you will be given the carrying amount. So let's say if you are given this is 290, this one will be 250. So an excess of
40.
An excess of 40. So that is revaluation gain. So or they can give this 40 direct. They can give us the 40 direct by saying what? What can they say? So they will say the fair value of the relevant asset, that is, remember the asset is the one which will be revalued. The fair value was in excess of carrying amount by 40. See, that is a revaluation gain. Or they can say that the carrying amount was below the fair value. Carrying amount was below the fair value by shillings 40. Again, that is a revaluation gain. It's just twisting English. Ni kucheza na Kiingereza.
Yes.
So that is okay. Lillian and Mary, mute your mic. I'm getting a echo from your side. You can only unmute if you are making a contribution, you are asking a question, that is okay. So now, this revaluation gain, where will I adjust it? So with revaluation gain, you do what? You debit the asset account. The relevant asset, that is PPE. Obviously, it would be PPE. Then we credit revaluation reserve. But remember that when I will be doing a equation, I will not be using those debits and credits. For now, I'm just creating an understanding. I'm trying to create a meaning. When I will be telling you that there is this aspect of adjusting property, plant, and equipment, I will just go to the property, plant, and equipment. Once I take my parent plus subsidiary, I will tell you to add revaluation gain and make other relevant adjustments. That is minus depreciation undercharge, minus UPFA, plus depreciation overcharge. So all of those addings and subtracting, that is what I'm explaining, debits and credits. So by now, I think you understand. By that time, you will be understanding what I'm doing by just doing direct. I will be doing direct. I will not be using the debits and the credits. So usianze kujisumbua kukrambe. You have to know debits and the credit, because I know this one is hectic to most of the students. Or it's not true. Debits and the credit. So due to revaluation gain, so revaluation gain, I would say revaluation gain leads to what? Leads to depreciation undercharge. It leads to depreciation undercharge. So once you have the revaluation gain, you have to check for depreciation undercharge. If the asset you are dealing with, the one which was revalued, is depreciable, the only asset which is not depreciable is land. So all the others are depreciable. Why am I saying this depreciation undercharge? Once you have a revaluation gain, because once you have a revaluation gain, like now the 40, remember that this 40 has not been subjected to depreciation. The asset has increased by 40 from 250 to 290. So the 40 has not been subjected to depreciation, meaning that in depreciating this asset, we did an undercharge because we based our depreciation on 250 instead of 290. So we need to know which is the depreciation inside the 40. So that is why we say initially you did an undercharge. So you have to determine the depreciation inside the revaluation gain. The depreciation inside the revaluation gain. So how will you find that, and how will it be adjusted? So for the depreciation undercharge, you will be taking your revaluation gain times what? Depreciation rate. You will be given a rate, or if you are given the remaining life, you take your revaluation gain, you divide the remaining useful life. Remaining useful life. So how would I adjust this in the books? Depreciation undercharge. So remember that the depreciation undercharge, initially, if we did an undercharge, our asset was overstated. At the same time, the profit was overstated. So we have to correct that. How would I correct this? So debit and credit. So remember that if the asset was overstated, so I have to deduct. So we credit PP, we debit the retained earnings. We debit the retained earnings account. So that is it for revaluation gain. That is it for revaluation gain. So other adjustments are, so number 4, we have intergroup owings or outstanding balances. And this one mostly goes hand in hand with cash in transit. Yes, this one mostly goes hand in hand with cash in transit. Cash in transit. So intergroup owings, that is whereby you will find that there is a parent and subsidiary. Then you will be told that, let's say, for example, A owes B. A owes B a certain amount like 200. A owes B a certain amount like 200. Anybody in the waiting room? Dahir is waiting to be admitted. And nowadays, where is our brothers and sisters from Rwanda? Are you present? The likes of Fenat, the likes of Peter, Gideon. So, A owes B. But I know right now most of the students are not attending because some are Muslims. There's this aspect of Ramadan. So at this time is when they call it what? Anyway, we continue. So right now in this scenario, we have A which owes B. A owes B 200. And then by the end of the year, you will find that this amount has not been paid. Remember that amount was outstanding. What is supposed to be done? So if A was supposed to pay B and A has not paid by the end of the year, so that amount must be disregarded. That is, it must be cancelled. So intergroup owings, for the intergroup owings, you just cancel them. Yeah, they're not carried forward to the next financial year. So how do we cancel them? They affect 2 accounts. So you debit trade payables account and you credit the trade receivables. Then for cash in transit, let's say like now this one, let's say 200 was owed by A to B. Then by the end of the year, the books of A shows that it owed B 150 instead of 200. Where is the balance? So instead of A saying that it owed B 200, A is saying that I owe you 150 because I had done what? I paid 50. It's only that you have not received. This amount was received, let's say, if our financial year ends on 31st December 2023, the amount was received on, let's say, by 5th January 2024, some few days after the end of the year. Some few days after the end of the year. So meaning that this amount must be recorded as if it was received by the end of this year, the 50. And now remember that the amount which will be outstanding still is 150 because the 50 has been paid. So it was on transit. It was received some few days after the end of the year. So for the cash in transit, remember that you debit cash, stroke bank, and you just reduce your debtors. Trade receivables is credited. So like now on this scenario whereby I'm saying that the amount owed from A to B was 200, but A is saying I owe you 150 because I've paid 50 and it was received later. On this scenario right now, the 50 is the one to be recorded here. Then the 150 will affect. The 150 will affect these 2 accounts. Any questions so far? Because we are done with the intergroup owings and cash in transit, so that I move to the goods in transit. The goods which are sold on credit basis. So the goods in transit, goods in transit. So for the goods in transit, so let's say these are the goods sold from A to B. So they were sold from A to B. So instead of the goods being received by 31st December 2023, they were received on 1st, let's say they were received on 5th January 2024. So meaning that they were received some few days after the end of the year. So at the end of the year, they were on transit from A to B. So these goods must be recorded as if they were received by the end of the year. So how would I record them? Debit, credit. So debit inventory, credit trade payables for the goods in transit. And so another terminology which is remaining, I think I've covered 90% of those adjustments. And so the only adjustment which is remaining is the dividends. How do you deal with the dividends paid? Dividends paid by investee company, mostly the subsidiary. Dividends paid by investee company. So for me to use these dividends, so the subsidiary must have been acquired during the year. Let's say if our financial year ends on December 2023. So for me to use the dividends paid by the subsidiary, this subsidiary must have been acquired during the year. Let's say by October. Let's say by 1st October 2023. So the subsidiary must have been acquired during the year. So you have 9, we have 3 months. So let's say we have A which acquired B. Then B was acquired during the year. So for me to use the dividends, B must have been acquired during the year. Then it paid a first and final dividend at the end of the year, let's say of 200. It paid a dividends of 200 by the end of the year, B. So where would I use my dividends? So you apportion these dividends for months. So 9/12 of 200, let's say times the percentage if the subsidiary was acquired 80% for 9 months. So this we call pre-acquisition dividends. This one we call pre-acquisition dividends. So the pre-acquisition dividends will be used in goodwill. They will be used as part of the net assets. So they will be used under goodwill. So they would be used as part of net assets, as part of net assets. So they will be used in goodwill computation as part of net assets. And for the post, so 3 months, post-acquisition dividends. So the post-acquisition dividends. So 3/12 times 200 times 80%. This one, where would I use them? So you credit in the retained earnings account. They will affect the retained earnings account. You credit in the retained earnings account. I think up to that point, then
I have a
once-
question, Malibu.
What?
And what about if the subsidiary is acquired before 1 year ago?
They will not affect the two accounts.
The dividend is usually paid by the parent to the subsidiary. So how the subsidiary
Dividends
can
will be
pay
paid from the parent to the subsidiary, and the parent acquired the subsidiary. So the parent has an interest in the subsidiary. So how would the parent pay dividends to the subsidiary?
So when we calculating the cash flow statement, and under the finance activity, we were calculating the dividend paid to NCI.
Yes, dividends paid by the
Parent
parent.
to the NCI.
So which, other than the minority shareholders being paid dividends, the dividends can be paid to the third parties, huh? other than the investing companies. So dividends, the one I will be mentioning, the one I'm focusing on anyway, in group accounting, what you will be focusing on, the dividends which are paid on the subsidiary, dividend paid by a subsidiary. For you to consider them, they have to, the subsidiary must have been acquired during the year. You prorate pre-acquisition dividends post. Dividends paid by the parent in group accounting, they will affect your retained earnings when doing the statement of changes in equity. So after doing that, so I think another thing I have to mention a bit is all about, because for the formats, I will not be doing the formats. The formats, you pick the formats and you understand them from the notes I have shared. Remember that other than the debit and the credit I've been mentioning here, this aspect of adjustments can be done direct in the consolidation when you are presenting your statements. So I could direct that on your free time, you make sure that you write these formats because they are very important. They will be playing a key role when I will be doing, or you just photocopy these notes. You have them. Even the other notes you have, there's a student who is asking handwritten notes. So even the advanced financial reporting. See, there's handwritten notes I shared to the group. Keep records. You have never seen them. They're around 196 pages. These handwritten notes.
Please read the note?
Sorry?
Could you please reshare those notes? There were 96 pages.
There were 96 pages.
Yes.
I will reshare. I will reshare. I know most of you have them. Those are most of the notes which are used. All right. So when I say formats of consolidated income statement, now here you need to understand that this work will be done direct when I will be doing consolidation. Like now, when we talk about revenue, you take the parent plus subsidiary, you minus intergroup sales. The one which took place. The intergroup sales which just took place between the parent and subsidiary only. Cost of sales, parent plus subsidiary, you minus intergroup sales plus UPS on closing stock. Now you know what's UPS. On closing stock, meaning that the goods which are unsold by the end of the current year. On opening stock, the goods which are unsold by the end of the previous year. Depreciation undercharge, I said it arises due to revaluation, overcharge due to sale of fixed asset. Then under investment income, you minus the share of dividends and the interest paid by auto investing company. Admin expense, selling and distribution, those are direct. You add parent plus subsidiaries. Then you introduce your impairment. Impairment, remember, you have to do working on goodwill. Then you have to check if you are told that impairment was at a certain percentage for you to go ahead and determine impairment. You get your profit before interest and tax. Then tax is finance cost. Then now remember that if there was, other than subsidiaries, if there was associates or joint ventures, before deducting tax, you have to check what you received from the associates or joint ventures. So you have to take the share of the profit after tax in those companies as your income. That is, as the parent is income. So you take your share of the profit after tax in associates or joint ventures as your income. Then now you get profit before tax, you raise tax, you minus. You get profit after tax, you add other comprehensive incomes. Then you have to share something to the minority shareholders, and what is remaining goes to the parent. We'll do an illustration. Format of a statement of changes in equity is this one. Statement of changes in equity in consolidation is based only on the retained earnings portion. You take your retained earnings for the balances brought down for all the companies which might be present in a equation, parent, subsidiaries, joint venture, or associates. Add profit for the year, the one which is paid by the parent, rest dividends paid, and you add a negative goodwill. So for the statement of financial position, again, you need to know which are the direct adjustments done. Like now the PPE, you add your revaluation. After taking parent plus subsidiaries, add revaluation minus depreciation under charge, minus UPFA plus depreciation over charge. Intangible asset is parent plus subsidiary. Investment in property, parent plus subsidiary. So investment in subsidiary, you replace it with goodwill. For the investment in associates and joint ventures, remember that you compute for their net investments using the equity method. I will be mentioning about the equity method in a few. For inventory, after taking parent plus subsidiary, you minus UPS plus goods in transit. Account receivable, the adjustment which is made is all about minusing intergroup balances and cash in transit. For cash, you add cash in transit. That is after taking parent plus subsidiary. For financial assets at fair value, it's present, it's just direct, parent plus subsidiary. Equity, like ordinary share capital, preference share capital, and share premium, you take for the parent companies only, the figures of the parent companies only. Retained earnings, non-controlling interest, revaluation reserves, those ones need workings. For the other liabilities which are remaining, like debentures, deferred tax, and loan stock, those ones is just direct, adding the parent plus subsidiaries. Under current liabilities, like payable, after you have added parent plus subsidiary, you minus your intergroup owings, and you add goods in transit. For the others, like current tax, interest payable, other current liabilities, is just adding parent plus subsidiary. Remember, these adjustments which I'm just mentioning right now under payable. The one I'm saying you minus under intergroup owings. You minus intergroup owings, sorry, and you add goods in transit. Remember, I have already explained the double entries. Like now, intergroup owings, which is deducted under payables, meaning that payable is done what? Debited. Which another account I said which would be affected is receivable, which is credited. When we credit the receivable, we are minusing. When we debit payable, we are minusing. That is why like now, intergroup owings is deducted in both receivables and what? You can see under receivables and payable. If it's goods in transit, I said it affects inventory and payable. Inventory you debit, payable you credit. So once you debit inventory, you have added. Once you credit payable, you have added. So all of these I've just explained. All of these adjustments are not just there. That is what I've been explaining. It's only that now in this statement, we do direct. We don't open T accounts. I always avoid the T accounts. So you will have to write those notes for the formats. They will be able to assist you in understanding the direct way of doing the adjustments other than doing the T account. Remember that we have to avoid them at all. The T account must be avoided. So finally, what I need to mention about the introduction of group accounting is all about the consolidation of associates and joint venture in the next around 15 minutes, and we call it a session for today. So consolidation of associates. So the consolidation of associates and the joint ventures. And the joint ventures. So associates and joint ventures. So what do we say? Joint arrangements and the joint arrangements. Because joint venture is a type of a joint arrangement. So when we talk about associates, remember these are entities acquired by the parent company between the percentage of 20% to 49%. So the parent doesn't have control in these companies. He has just an interest. an interest which is called what? Significant what? Influence. So the parent has a significant influence in the associates. The parent doesn't have control in associates. He has a significant influence. So of which you need to know the indicators. Indicators of significant influence. The indicators of significant influence. Like now the representation, and many more. These are the indicators which are here. So indicators. So participation in decision making, interchange of key managerial personnel, representation in the board, provision of essential information. So those are the indicators. So when accounting for the associate, use the equity method, where the associate is initially measured at cost. So when we are accounting for the associate, we use the equity method. How does equity method looks like? So you start with the cost. So initial cost, the associate is measured with initial cost. Then we add what? Share of post-acquisition. The share of post-acquisition, profit, or reserve. This one is added. Then we raise what? Impairment loss. We deduct the impairment loss. That is how you get your net investment. So this is the equity method. Even if you are told to explain, you say the associates are accounted for using the equity method. The equity method says that we measure the associate with the initial cost, you add the share post-acquisition, profit or reserve, we raise impairment loss. But now there's a time you will find that there's exemptions to the use of equity method. Exemptions to the use of equity method. Exemptions to the use of equity method. So on which scenario the parent can be denied the opportunity? On which scenario the parent can be done what? Can be denied the opportunity to use the equity method. Exemptions to the use of equity method to account for the associates. So these are the exemptions like the one we mentioned when I was talking about the institution and legal frameworks of group accounting. They look the same. Exemptions. The parent company is partly, wholly, fully, or owned by another company. Equity instruments of the parent are not public trading in the stock market. That is shares of the parent are not trading. Financial statements of the associate has already been consolidated by another immediate company. And the acquisition of the associates was meant to last for less than 12 months. So those are the exemptions. So joint arrangements, remember that this is when two separate entities have an equal interest in another company. Right now, on the scenario whereby they were saying that H&M were acquiring L 50-50. But remember, due to the information which we were given, L was qualified to be a subsidiary. But now I'm trying to say that for joint arrangement is whereby you have equal interest in a company. Me and you, we acquire another company, 50-50. So types of joint arrangements, joint operations, ventures, and assets. Operations, this is whereby the parties have equal rights and obligations to the assets and liabilities. They have equal rights and obligations to the assets and liabilities. For ventures, the parties have equal rights to the net assets only. That is the equity. Then we have joint assets. The parties contribute equally to the investment. And see the difference of the three. So consolidation of joint arrangements, they are just consolidated the same way as associates using the equity method. Using the equity method. I think that is it. That is a short introduction which I've done. But before we end the session, remember that in the advanced financial reporting, these are the questions we'll be doing. It will not be the same as financial reporting, section 3. So here, I will do around 7 questions. 7 questions for me to finish group. So these are questions I consider for normal group, normal consolidation. The one you did in section 3. So these are questions whereby I will do around 2, whereby you find that the parent had acquired subsidiaries, and the parent can acquire sub-subsidiaries. The parent can acquire sub-subsidiaries, associates, and joint ventures. Associates and joint ventures. So here we'll do 2 questions. The parent acquiring this. Then after that, after doing this, you will come to disposal. We will come to disposal of subsidiaries now. Remember that subsidiaries, after they have been acquired, they can be disposed. So disposal is either partial disposal or entire disposal. Partial or entire disposal. Entire disposal can be at the end of the year or during the year. End year or during the year. So we need 1, we need 1, we need 1. So here we need 3 questions. So +2, 5. Then after talking about disposals, we have to go to foreign subsidiaries. So foreign subsidiaries, whereby you find that subsidiaries which are acquired are in a foreign country. So the parent acquires a foreign subsidiary in another country. The parent is in Kenya, the subsidiary is in the US. So we do 2. So 2, 5, 7. And we have to do a final question whereby there is which is a last year question, whereby you find that they call it step-up acquisition, whereby you find that initially, it's not even reciting. I think there's a question whereby you find that initially, the percentage of acquisition was like 40. Then there's an addition which is done of 20. So by the end of the year, you will find that the percentage was 60. So we have to do a question of this kind, whereby the percentage is acquired. The acquisition is not that which is done once. They acquired this percentage, then they added another one. So we need around 8 questions to finish group accounting. And I think you will be okay to do any question of group. That is the end for today. See you tomorrow when I will be doing my first question in group accounting. Is there any question? Any question?
I'm asking, will it be possible to do all the 8 questions within this remaining time period, and with the kind of the time we have?
I will do them. We have time. I will do them. If I decide I'm
What about published account?
that is why I said after finishing this, I will be able to check another work which might be remaining. But published is the same thing you did in section 2 in FI, and it's just the same. There's no difference FR published and the advanced. There is no difference. But I will do. So I think over the weekends I have to get 1 or 2 classes in the coming 2 weekends. You have to commit now for the time remaining so that we finish that work. Have a good night. See you tomorrow.
Okay, thanks so much. Or maybe TG, you can share with us the video for the published so that we